if we touch base on modern portfolio theory, I'm a strict believer that you must diversify your portfolio and you must be aware of your risk profile from T0. Otherwise, you would be making emotional decisions, and that can hinder, your perspectives. Just like you said, how much added value you can put in the investment yourself is something that needs to be considered from day one.
Hey everyone, here's another episode of the B2B Growth Hacking Playbook, and I'm here with Angel Hadjiev, who is a dear friend of mine, currently the managing director of SeedBlink with a very impeccable track record in investing. He's a mentor at Endeavor. He spent nearly 7 years, maybe even 7 years in Deloitte, so have a big respect in the kind of big four and the general consulting ecosystem. Former fund manager and many other accolades that I'm going to let Angel to present here. Hey Angel, thanks for being here. How are you doing today?
Thanks for having me, Mario. Always a pleasure. I hope to be useful for your audience today.
Yeah, absolutely. And oftentimes I do present people who are named Angel as Angel, but since we are also going to talk about angel investing a lot, I'm trying to delineate a little bit here. So there's that.
I get that.
So the two of us met, and I'm trying to give some context when we were starting the podcast, but the two of us met a couple years ago or so through SeedBlink when I was looking into investing opportunities in the European area. And I was really impressed by your command and understanding of the investing space, your background in actually managing larger transactions and funds and debt collection and so on. So I know you're very well familiar, not just with the angel investing space and the kind of angel crowdfunding space, but also venture capital. And you do participate yourself heavily and actively in analyzing deals before they make it to the marketplace itself. So let's walk through kind of the day-to-day of what you do and what you see in the current market today.
Yes, that's correct. My background is M&A, corporate finance, and so throughout my career, I've actually analyzed different sorts of companies. A few years ago, yes, I decided to join SeedBlink, and SeedBlink is an investment platform, allows for investors to be able to access a very otherwise limited asset class, which is the technological startup companies. Typically, if you don't have, let's say, 250,000 euros a ticket allocated as a limited partner or an LP to a venture capital fund, you don't have access to that asset class. And therefore, this investment platform is beautifully suited for those retail investors that also want to tap into those opportunities, be it primary market, secondary market, or wish to enter a specific vertical that otherwise will not be able to do so. What we've seen over the past few years, and that's not a surprise, I'm sure, to any of the listeners here, especially after COVID, something that we call health tech or MedTech has skyrocketed in terms of deal flow, number of deals, but also value that we've had on the platform. I think whenever somebody invests in any of those verticals, there is an element, especially in retail investors, there is an element to relatedness, how related you are to the problem that the company is solving. Therefore, if we're talking about cancer eradication, people immediately don't want to go into the details of the technicalities of any one solution, but they feel obliged to contribute to such an asset. And therefore, other than health tech and medtech, traditionally B2B software as a service has skyrocketed over the past 4 years maybe. What else? FinTech, as we call it, InsurTech, things like that, which provide for a higher probability of a higher return on your investment.
That's a great breakdown, and I'm going to double click on some of the medtech and the health tech examples you provided, because in many cases, and kind of my previous exposure to angel investing is primarily helping and supporting businesses within my own ecosystem. So companies that I'd normally back up and I'm going to meet at events and conferences, but not necessarily some that I deem, let's say, significant. For instance, one of my investments through SeedBlink is in InHeart, which is kind of an AI-enabled digital twin. I fully realize that I'm not going to make a massive difference because it's an enormous investment required to completely change the state of heart surgery. But it definitely makes me feel so good to be a part of that and kind of get close to the process and the ongoing developments and the quarterly breakdowns and everything happening on the platform. So just the ability to be a part of that, even a kind of small ticket member with several $1,000s of your investment, is something that certainly makes a difference. And the other thing that you also brought up that's really important, again, anyone who isn't investing actively, for the most part, you do need a $250,000 to be able to join a fund in the first place. And again, most people, even if they do diversify their investments, even kind of high net worth individuals, they may oftentimes not have that amount to be investing in kind of a liquid investment for 5, 6, 7, 8, 9 years, maybe more. And second, this may not be often more, yes, or this may not be part of their investment strategy in the first place. So what do you see kind of the state of 2024? There's definitely a turbulent environment out there. What do you see in terms of deal flow, pipeline, differences between, let's say, B2B and B2C investments and some other trends that you see on the platform?
Well, okay. Finishing off with a little bit of statistics. So enterprise software is traditionally and has continuously been number one in terms of verticals that people decide to invest in. And not just people, that's venture capital as well. In general, private equity and venture capital has traditionally backed enterprise software. Like, I think in 2023, it reached up to 60 billion at some point. Then we had FinTech, which was 54, if I'm not mistaken. Then we had HealthTech, which was about the same range, 52, 54. And what is important, actually, I forgot to mention, that's a vertical that's becoming even more and more important these days, is energy, or whatever we want to put into clean tech, sustainability, ESG, whatever the vertical may encompass. So those numbers, I think, are very important in terms of where we seek return on our investment. In terms of what you're asking me, where the market is going, I think there's a reason why a lot of and not just European funding dynamics, but global funding dynamics reveal that B2B versus B2C investment typically yields a higher yield per dollar spent. I can give you some statistics with regards to that. I think in 2017, for every $1 that was invested into B2C, $1.6 were secured in B2B ventures. I think that statistics moved to 2.4 in 2023, and in 2024 up to today's date is $2.7 for every dollar that you spend on B2C. There is a search for that, and there is a reason for that. I think Boston Consulting Group had actually put it very bluntly. The expected revenues on B2B software as a service enterprises are typically 200% and above higher returns than that you would expect on B2C. So it's simple. Where do you expect higher return for payback period, which is lower? And that's something that the investors, you don't have to be a sophisticated investor to come up with your own maths. Time value of money. Some people are far distinct as a concept from it, but still they realize that if they make 2x the money for the same period of time, then they do 110x or 1.1. I'm sorry, 110%. There's a difference there.
I like where the conversation is headed, primarily because the show's name is the B2B Growth Hacking Playbook. So thanks for bringing up these stats that are making us feel better. What I can kind of add to that is, and I get invited every now and then to talk about e-commerce and starting stores and all that stuff, primarily due to the fact that I saw the Shopify SaaS business, 8 months ago. But in reality, over the past, let's say, 18 years or so in my career, I've spent 17 in B2B. So with that in mind, there's a good reason why I do believe in the power of business-to-business relationships, in the efficiency of building high-scale deals, primarily due to the economy of scale, in a sense, just higher margins, the ability to provide more time into strategic consulting, into supporting the business endeavors, right? If let's take one consultant as an example, regardless of whether you're a coach, consultant, advisor, mentor, whatever it is, any third party that comes in. It's one thing, signing a contract for $500 to consult an e-commerce store, or $5K for a small and medium business, or a $50K contract for a small and medium enterprises, or a $500,000 contract for a B2B enterprise, right? So like the same person, hypothetically speaking, the same person can be placed in all these seats if they're capable and knowledgeable enough. But the level of insights they can provide to the tiny little starting e-commerce or the SMB is just a tiny fraction of the mind exercises they can put into a more complex project in the first place. That's very just important to kind of segment and understand that the power of money is often about attention span, about creativity, about critical thinking, about availability. And that's also something that we discuss oftentimes in the professional services industry, right? You can find a lawyer for $20 an hour, but you won't rely on them to get you out of the jail when the time comes. You're going to go to the most expensive one, most likely, and there's a good reason for that. So that all applies for pretty much every single segment out there.
Listen, I fully concur with what you're saying. In the opening sentences, you said that I also actively invest myself. I'd like it to be true, but I'm very much a passive investor. And let me explain why do I consider myself a passive investor. An active investor is 24/7 dedicated to his portfolio. I'm not. And the reason for that is that I have fiduciary duty to whatever it is that I do with SeedBlink, investors, startups, and what have you. Therefore, if we touch base on modern portfolio theory, I'm a strict believer that you must diversify your portfolio and you must be aware of your risk profile from T0. Otherwise, you would be making emotional decisions, and that can hinder, your perspectives. Just like you said, how much added value you can put in the investment yourself is something that needs to be considered from day one. My portfolio is very passive in such a way because, first of all, I don't sit on the board of any of my investors. Therefore, I don't have access to make any strategic decisions whatsoever. Secondly, my tickets are so tiny, like you said, in the health tech, where they need billions to go into commercial stage.
Exactly.
And right now they're just testing with different medical devices with different universities. By the way, InsurTech are performing tremendously. You should follow their feedback in terms of quarterly reports. But where is my added value there? Tiny, very tiny. And therefore, I fully concur with what you're saying. People should be aware of what they should expect from their portfolio and how much that reflects their own risk appetite. I've often been discussing this over the past couple of years, actually, maybe more. People asking me to give them an advice on a particular opportunity. And it's a tricky business. First of all, I do have a fiduciary duty. I realize that, but I cannot make a decision on their behalf, number one. Otherwise, that would make me a broker, right? And that's a whole different game, a whole different license. I'm not there. And SeedBlink is not there. What SeedBlink does as an investment platform is it allows for investors to make an informed decision based on all the European regulation requirements, whether or not it fits their investment criteria. We do make an analysis on any deal that we launch. That is true. And often is the case that whenever we have deals which are backed by a VC, a venture capital fund, we take the due diligence because we don't have the time to do simply our own financial, legal, etc. We identify the red flags in that due diligence and then decide whether it fits our investment thesis, and make a decision whether or not to give it to our investors to also have the opportunity to invest. But just because it's there doesn't mean that it fits everybody's criteria. That's what I must underline, must put in bold, italic, whatever, so that everybody understands it. The first thing that any investor should do, retail, sophisticated, affluent, high net worth individual, regardless, is where I currently stand, where do I want to be, and how much of that portfolio that I decide to allocate will negatively impact my well-being if I lost it all. Because let's face it, what we offer is an alternative asset class. An alternative asset class which is not stock, it's not government bonds, it's not easily liquid, although the European license that we have allows us to structure secondary market, and that's very important, by the way, to mention there. For instance, you and I could trade if we are on the same cap table of any one investment, which allows for some form of liquidity. Just to give some more numbers, I think my colleagues just recently published, we did 3.7 million in transactions on secondary since we launched it last year, which I think for a small investment platform, it's something to say. We're not a stock market, so it gives some form of liquidity or early exit to investors.
I love the breakdown there and several thoughts. I'm going to break them down real quick. So first, in terms of investment strategy, back in the day, I remember my like in the early 90s, late 80s even, well, let's say the early 90s, I remember it was pretty common to, let's say, allocate a fund or like an insurance or so for kids until they turn 18, so that they can cash in and like get an upfront loan for an apartment, like probably the first mortgage or something like that. And then the denomination in the area, like particularly Bulgaria, came in year 2000, I believe, and suddenly a lot of banks and insurance firms and so forth devalued all of the investments that people have been waiting on for a decade. So sometimes great investments that are still illiquid and you're waiting for 10 or 15 years may not pan out the way you expect. The same thing may happen with real estate. The same thing may happen with, again, venture capital, with let's say the stock market is slightly different, but then again, crypto, gold, whatever it is, there are always risks, and that's why the diversification strategy is so different. In terms of picking your right opportunity, you and I had a conversation maybe half a year ago, maybe a year, and when Dronomics were listed, and they're, again, also the unicorn, the very first drone cargo company, pilotless in the world, invented in Bulgaria by Konstantin and Svilen Rangelovi. So great product, incredible, really mad respect to them. I've met them a couple of times as well. But it was not an investment for me, right? I do, as you said, like they've already raised tens of millions of dollars. It's super proof of concept. They're essentially revolutionizing both the logistics space and the shipment space, but it's also close to e-commerce for me. So this is just not a space I'm passionate enough for. And this was kind of the main reason why I just pulled up. I said, I'm pretty sure they're going to raise whatever they need. And then on top of it, but they also need to be passionate about some of these investments. So it's really important to be involved kind of even emotionally and even support that as best as possible. Otherwise, yes, some businesses need capital, but great businesses can find capital nevertheless. There are tons of opportunities for the most part to raise. It's more about what's possible, or whether you can contribute something else on top of that. But the secondary market, I just ask you to expand on that a little bit, because that's how I actually bought SeedBlink stocks. I mean, I missed the initial round, so I waited for the first iteration of secondaries. I couldn't get anything. Eventually bought the second one. I also have Alcatraz stocks that are trading back and forth on secondaries. So this is Klarna right now is on secondaries, right?
Yep, that's correct. We offer to our retail investors Klarna.
That's a great opportunity, and again, I think I love to feature that more prominently, because a lot of people are just not aware of that. let's say I'm a user of Klarna, I'm an angel investor, or just a high net worth individual, and then this is an opportunity I wouldn't find elsewhere, right? I can't go to S&P 500 and get it, right? I can't. It's a pre-IPO. I can't go on another platform that's angel investing because they're not raising right now. It's essentially the secondaries market. It's what making it possible to join that company before it goes to market. So the opportunities are, it's a unique opportunity in itself,
I couldn't agree more. So just a step back for those that haven't transacted on secondary market. So what we typically offer is an opportunity for any investor to go into an investment, and that's what we call primary market, right? That's the first market. Pre-IPO or post-primary is something that we call secondary transaction. Like you rightly said, Klarna had given us a chance, had allocated us a ticket up to 1 million euros to transact pre-IPO. As far as I'm concerned, the difference is whichever source you decide to trust, but whether it's Bloomberg or Forbes or whatever, they expect within the next 12 to 18 months Klarna to be listed. Therefore, if I'm an investor willing to access this investment opportunity on a secondary market, I have a clear exit strategy. And that's very important. Like you rightly suggest, like this market is very illiquid. And therefore, if I have a clear strategy, which is already written down, of course, anything can happen. Tomorrow they can change management, they can, there can be regulatory issues with Klarna, you name it. I think, in the UK, there's always changing regulatory concerns. So, however, that gives me the untypical exit within 18 months. And I know I can calculate based on forecasted fair market value that's calculated by Morgan Stanley, not by just any other bloke, Adam Smith or whatever. John Smith, I'm sorry, should be using John Smith. But Morgan Stanley say that the IPO is expected at an X billion valuation. The shares that are offered through our platform today are at an X with a discount. Therefore, if you enter today, not only you are able to get these shares at a discount, but also the upside potential for the next 18 months can be calculated in your model. I think secondaries are becoming and have become increasingly important over the past 6, maybe even 12 and 18 months, actually, because investors, again, regardless whether affluent or retail investors, are eager to see some form of return on investment. And there's no longer the hype that we were there, like in 2021, people were investing like crazy, sometimes without even reading the books, without even reading the pitch deck. That was crazy. I'm glad we're not there. But that came to the realization that you should not just throw money at just because it's there, just because somebody told you that it's there, it's fancy, you should also hop in and not miss out. So I'm glad that the secondary has become increasingly more important, because investors, that's a clear sign that the investors have become more aware that those money should yield some return.
I think in hindsight, if I had to zoom out, what we're seeing today is, and something that we discuss pretty much every single week on the show here, but the downturn of the B2B ecosystem, the massive layoffs that started with Meta in late 2022, that Microsoft and Google and pretty much everyone else, Oracle, Salesforce, not, and just like mass layoffs, not hitting expectations, low KPIs, long buying cycles, all these concepts and trends and kind of issues that have been bubbling up and repeating over the course of the past, almost 2 years by now. So that level of recalibration was due to the massive bumps, large VC funding, large angel funding as well, businesses booming with the hockey stick growth, reckless investing, I would say, honestly, for the most part. And Yeah, this is definitely something that we're seeing here as well. In one of the past, probably the past 2 or 3 episodes here, I interviewed Mani Iyer, who is the CEO of Quanzu. He sold PeopleSoft to Oracle 20 years ago or so. He's a really sharp entrepreneur, and we've been talking with him about his buyer level visitor identity data, essentially plugging a pixel in and identifying about 20 to 25% of the users on the website. So go and check out the previous episode if you haven't. But so he is one of the disruptive players, and he's a bootstrap. So essentially brought a business from 0 to like 7 figures as a bootstrap business, going after companies like Demandbase, 6sense, ZoomInfo, and others, and kind of completely disrupting the space. So ZoomInfo, I don't have the numbers in front of me, but their valuation dropped maybe 7 times over the past couple of years. It was a pretty massive slash. 6sense, I watched an interview with the CEO from 2020, I believe. And in 2020, their burn rate was $1 million a month. And the reason this is important is, in that case, 6sense, and they mentioned like average contract value, I believe, was $150,000. In comparison, Quanzu starts from $100 or $500, so it's completely different. Most clients are paying $1,500 or $2,500, and not $12,000. So it's like a 10x, 7x, 10x discount. At the same time, what 6sense presents primarily is account-based data, meaning they tell you what's the company visiting your website. Quanzu provides who's the person visiting your website, and so on. So the reason I'm making that parallel is what we see is definitely a massive disruption from bootstrap startups, indie creatives, agencies, and other businesses, and also like some based on GPTs as well, completely, entirely transforming enterprise models that have been successful in 2019 and 2020 due to the massive boom of VC funding, being able to confidently and comfortably burn $1 million a month easily. And if you just think about it, it's not a scalable model. And right now we are mostly moving to normalization. So it's not a mascot in the way of, hey, we're all doomed and gloomed. It's more about normalization of whatever was possible to achieve the hockey stick growth just 3 years ago.
That's very interesting that you're touching. I mean, first of all, if you allow me to add on some stats that I have with regards to that. When we talk about the leaders and the laggards in Europe, traditionally, we know that UK, France, Germany, and Switzerland are the ones which have received massive funding from venture capital. I'm talking about B2B specifically. And those countries for VC funding have traditionally been so. Whether or not they can afford to burn $1 million per month, it's a great thing to be raising, because what I've witnessed, and I think statistics can prove that as well and back me up on that, is that traditionally European B2B or B2C actually target companies have struggled to get into that funding because of bureaucracy, because of access, because of risk appetite from behalf of the VCs, and therefore they have been forced to be economically efficient, or at least more economically efficient than across the pond in Delaware or somewhere in the States. So I think in that regard, even today, with the rising prices of any IT engineer that is here in Europe, we're still sort of on par with the East Coast, not with the West Coast, right? I think we're still far away from the West Coast, but in terms of capabilities, in terms of sheer talent that you can acquire as a VC, I think it's incomparable. Other things that I want to point out is that although that I say that B2B SaaS is traditionally heavily backed up, we still cannot ignore that, for instance, the level of exits has decreased in B2B SaaS. And that's exactly what you're telling me. The multiples are down and people are wondering, okay, whether or not to hold it for another 5 years and then do an IPO or sell it to a strategic investor. I think to put some concrete numbers, in year-to-date 2024, we have just above 1,000 exits in B2B startup, which is close to the 2019 figures. So
crazy.
Pre-raise, it's a complete slump in that regard. Also, if we talk about the so-called Series C or Series D or above rounds this year, it's unsurprising, but the average check sizes remain stable at early stages, but average C plus, D and above have gone down tremendously in 2024. So, this is an economic situation. Over the past, I would say, more than 12 months, we have high inflation, interest rates now becoming to decrease, right? But all of this economic uncertainty, there is a talent gap, whatever there is, still prevalent. I think business leaders need to, and they have indicated that they're not ready for those trends. And that includes B2B companies, to be frank. There's declining demand, like you say, they're losing on invoices. There's geopolitical uncertainty that shouldn't be ignored. Like we have a war 600 kilometers away from here. That cannot be ignored. And it is relevant. It is relevant. We've had this discussion pre the recording. Everything that happens across the Atlantic sort of takes another 12 to 18 months to be reflected here in Europe as well. That's true. But I think with a pinch of salt, grain of salt, we should be expecting at some point a decrease in that demand.
Lots of great points to cover here. On the one hand, and again, I can double click on pretty much everything you mentioned. In terms of kind of Europe and the dry market and kind of comparing to the eastern part of the world, a Forbes article that came out just maybe on Friday or so, last Friday, also kind of touched on, and it's kind of a good Google read. It's called Europe's Unfair Advantages. And they looked it up, and even though I feel that Europe is very disadvantaged in so many areas, thanks to the European Union, thank you. But for the most part, so the author covered a lot of different factors, such as cost advantages, for building, like you don't have to burn $1 million a month. Once again, it's kind of more cost effective. There are rich academic institutions. There's government support, which is the part that I primarily disagree with, but regardless. Fragmented, but also very interesting market with different cultures, founder resilience, because it's, people are more resourceful, they don't give up that easily, room for growth, and kind of other factors like economical, social, and so forth that are kind of playing. So for the most part, I think it's a very, someone put on their pink-eyed glasses and is kind of taking a look from a different perspective. But it's also interesting because it also reveals the fact that Europe is a pretty large and broad market with some incredible startups that you and I know of, tons of unicorns that are pretty exciting, especially in countries like some of the Nordic countries or Estonia, or again, including some in Bulgaria, of course, that are pretty successful and fast growing and kind of disrupting the space. Or Booking.com, I believe, was from the Netherlands, if I'm not mistaken. So there are pretty successful, great, large stories in Europe that's kind of undermined. But I think if we have to double down on, and again, considering the average listener is an executive, director, founder, maybe an investor themselves, but like a traditional investor, like maybe limited partner somewhere, and looking into different growth strategies or looking into ways to sleep well at night, especially during this down market. So if you were to kind of manage someone's, let's say, wealth portfolio in a sense, how would you structure that so that the premise... So again, I'm pretty sure that your strategy 2 years ago would have been completely different from anything we see right now. So how would you manage that, like a step-by-step type of thing, so that it's valid today, it's diversified, but it's also flexible enough to accommodate for what happens in 2025, late 2025, 2026, and going forward?
Good question. So my strategy has actually not changed that much. I tend to invest myself in only things that I understand. That's number one. So you will not see me put money into crypto until there's a strict framework to understand crypto, and it's not pure speculation. For me, that's beyond my risk appetite, essentially. There are people that I've seen that made a lot of money into crypto. I'm not that type of risk taker.
Same here. Yeah, I feel too
Yeah,
weird. Yeah, just a gamble is what I was going to say. Like some people are lucky, but I can go to a casino with the same level of success. Like it's based on nothing right now. So
it is based on no rules that I can understand. Okay, investing for me is more than just a series of transactions. Okay, some people decide to go to professional advice, to a qualified expert, and knowing that someone they trust is looking out for their best interest. It's about having a seasoned professional monitor their portfolio so that they can focus on other things. You know, a lot of the people that I talk to sometimes invest out of emotion. I said it before, I think that's not the right way to do it. I think they do it out of emotion, because somebody else is doing it, but they don't have a strategy. They don't have an overarching strategy as to what they want to achieve with their wealth and how much should be allocated of their wealth to that investment. What I would point out, other than the companies that you also mentioned there, a lot of the, again, B2B SaaS companies that managed to raise over the past 6 to 12 months are very interesting. You would not be surprised to hear a lot of them have an AI or machine learning aspect into it. I'm not gonna, discover the hot water if I mention, V7, Parloa times Silvera from the UK, Poolside from France. They managed to close 90 million just recently in Series B. Quadrant, Adaptive Machine Learning, etc., etc., etc. And all of those companies have one thing in common. They no longer put AI just an abbreviation. They actually try to use AI to make an industry think in a different way. And I think any investor should not ignore those trends in any vertical. I think AI is not just, it's just a tool that helps any vertical. So I think there's a huge potential there, definitely, regardless of what you understand. Going back to basics, you must at least have a basic concept of what the industry you want to invest is doing. I would not recommend any investor to be putting all of his money into health tech if he's into, I don't know, e-commerce or whatever. There's plenty of things that they can be looked at. I also suggest that they consult a legal and a financial advisor as well, because sometimes the way you enter into any one deal, because of tax and legal perspectives, can be detrimental to your otherwise brilliant and sound decision, which can be taken by gut feeling. But if you don't structure it well, you may not reap the benefits out of it as much as you could otherwise. That's why the advisors are there, and it also comes back to how much you want to invest, how much your net worth is going to be impacted. And that, provided you lose everything, should never affect your well-being, your ability to sustain your life for the rest of your life and your family. By the way, people should start financial planning when they think of having a family, kids, wife, etc. I do not dismiss real estate and real economy. That's not what I'm saying. Quite the opposite. I think what's been said hundreds of years ago about diversifying your portfolio, about being smart into investing only that much that you're willing to forego, I think that still applies, and especially applies these days when we have, turbulent times.
I'm definitely going to point people your way. I know you're very friendly and receptive and kind of helping and assisting with kind of conversations and stuff, but pretty sure you need to kind of move into the also professional wealth consulting or family offices realm in one way or another in the kind of near future. But in the meantime, one thing that I'm also going to suggest is again, unless that's against the terms of service or so, you can probably start a newsletter for just kind of warming up and kind of providing different perspectives. I can give a personal example. I have a blog post on my blog, which is 30 ways to diversify your portfolio show. It's one of the top read and most searched blog. It's kind of one of my top 10. So we have biggest business challenges, consulting rates on the market, different types of business advisors, 22 leadership kind of traits, discipline, focus, and all that, and the diversification and also marketing approaches. These are my top 6 posts on my website. So heavy interest and kind of attention and people looking for that and trying to kind of make it a living. So even though it's making money generally and is a competitive space, I think that your background is definitely super suitable for something like that. So
Thanks, Mario. I mean, I couldn't reinstate it more. I've been, talking with a lot of very clever individuals. A lot of them IT engineers. A lot of them have done their money through selling their businesses to US companies as well. But the realization that you should not necessarily know everything, including investments, is the first sign of how sophisticated the market is, right? And seeking professional advice is just like, seeking, professional advice when you go to a psychiatrist. You have to realize that you have a problem first. And there's nothing worrisome about that. And there's no stigma. There shouldn't be any stigma. Asking somebody that knows more about how to structure a portfolio. He or she should perhaps not take decision of your entire net worth, like it's done, for instance, let's say a family office across the Atlantic. Sometimes it's entirely fiduciary duty, and you have the ability to invest on behalf of your investors as a professional manager. I doubt Central and Eastern Europe is mature enough as a market to see that yet, but it's on the verge of becoming more and more aware of other opportunities, of ways that you can put your money to worth, to make it worth.
Years ago, when I first got serious into the stock market, for example, so it's probably 6, 7, 8 years ago. I don't remember when, but I called my, and again, I had been investing previously, but mostly, some money in S&P or maybe buying a high growth stock or something like that. Not very intentional and very strategic about that. So I called a friend who was a financial journalist for 2 decades and said, hey, I need to pick your brain. Kind of, I just want to do that monthly and allocate some budget and all that stuff and whatnot. I was like, what does it take to kind of make it happen? He was like, well, first off, as someone who's going to be responsible for the money, it's going to cost you $500. Come pick me up. You're going to grab some lunch, and I'm going to download it for you, right? So, even if it's a friendly conversation, it's also important to understand that when you talk about money, you need to be serious about money, meaning that you need to respect money and you need to understand that it's also an investment. So, no free advice is helpful. I've realized that my $20 online books, if I run an A/B test and run it as a free one and the paid one actually gets more attention because people see it as value driven. The other one is just dusting into a downloads folder. But either way, I met him. We built the strategy. Part of that was essentially 2 indexes, particularly in Europe, that were tax efficient for Europe. So we're not doing the double taxation in the States. We're not it was pretty. There are these fine details that people don't understand and can actually eat your head at the end of the day. So just going through this as a starter and some other aspects further. And this was essentially the beginning of kind of how I started building my stock portfolio in the first place. So I fully, you gave an example with like therapy or coaching or so. There is some stigma around some of this, but if people are serious about something, I've always said that great athletes have coaches. Great, like top Fortune 500 entrepreneurs, they do have business mentors, right, and advisors. So who are we to judge people who are far more successful than us and have accomplished more, who do understand that and want to keep leveling up and stop hitting ceilings at the end of the day?
That's spot on. That's spot on. And professional athletes have, like mental coaches as well. So I fully concur with what you're saying. If you allow me as a closing remark, people invest for different reasons, with different goals, different motivations. Some think short term, crypto. I want to be rich tomorrow. Others long. Some may be planning for retirement or seeking to preserve their assets to retirement. As I said, many parents want to provide their kids with a post-secondary education, which is heavily expensive these days, especially when the UK went out of the EU. Others are simply interested in growing their assets. And like you rightly said, who doesn't want to minimize taxes, legally? Okay, I must.
Very important, yes.
I must put a disclaimer here.
Yeah.
Legally, always legally. But as is true for much else in life, having a strategy is key to achieving the outcome you want with your investments. You could take an ad hoc approach. I said many people do, and make decisions on the fly. But having a plan is more effective in the long run for achieving those goals. So the question remains: do you want to do it alone, or let the experts also help you with this? And I think it's personal choice at the end of it.
Great wrapping thoughts. Thanks again for stopping by. There's a lot to unpack here. So how can people find you? Anyone who has follow-up questions, and I'm going to do a prompt for the comments, of course, so that people can ask down there. But
okay, how does it work? Shall I give my email, the mobile?
There's no censorship here, so whatever you want to provide in public.
All of it. I mean, they can nudge me on LinkedIn. They got my email there. I'm pretty open. I actually respond pretty quickly, I think. There was an anecdote told by Professor Asfat Damodaran, a valuation professor from NY. In one of the lectures that I attended, he said, I knew that this person didn't know me because he used autocorrect all the time when he addressed me. He said, "Dear Professor Deodorant."
Oh, wow. That's
LinkedIn, I'm always there most of the time, and I can leave mobile and email address anytime for questions that you might have, guys.
Love it. You're super accessible. I had one of my mentors told me that I need to set up a form for free consulting course, and I was like, I'm never gonna do that. Like, freeloaders tanking my phone. I get 90 pitches every single week as is. I just don't need people to start calling me 24/7. So thanks, but no thanks. And this is not James, who is just on the previous episode. So just one of my other consultants, but yeah, this is not his strong suit apparently. But yeah, thanks for being on the show, and everyone who enjoyed the episode, please drop any comments down there for Angel, and press like if you like it. If you have any ideas for additional guests or someone else we need to invite on the show, let me know. We are picking up the growth B2B growth hacking playbook, and it's shaping up pretty nice. By the way, we just had 500 subscribers like 3 months ago. Right now we are almost 9,000. So the show is growing pretty well, and we are going to push it to the tens of thousands next year with your help and support. So any like counts. And yeah, thanks for your attention. Thanks for your time, and see you in the next episode.